in this example how international trade increases total surplus and improves efficiency. But first, let's start with a situation where there's no trade. It's just a domestic market, and this is the soybean market. The soybean market is in equilibrium at $4 per unit of soybean, and 500 units are bought and sold. Let's identify consumer surplus, producer surplus, and total surplus without trade. We know without trade, consumer surplus is the area between the demand curve and the price line. Consumers are buying soybeans at $4, and here we have the buyer's willingness to pay on the demand curve, and the difference between the area between the demand curve and the price line will give us the consumer surplus. Producer surplus is the area between the price line and the supply curve. It's this area, producer surplus. Total surplus will be the total of consumer surplus and producer surplus. Let's put that here. Total surplus is consumer surplus plus producer surplus. Now let's allow trade. In the world markets, soybeans are traded at $6. The world price for soybeans is $6. There's an opportunity for the domestic producers to sell their soybeans at $6 instead of the domestic price $4. Let's add that world price here, $6 world price, and now the sellers are selling their soybeans both in the domestic markets and in the international markets at $6. This is the world price. Now, since domestic consumers are buying their soybeans at $6, what happens to their consumer surplus after trade? Let's put that here, after trade, consumer surplus decreases. Here is the price that the consumers will pay, and some of the buyers will leave this market because now the price is $6. Only these buyers will participate in the market, so the consumer surplus will shrink, and it will be this little area. What happens to producer surplus? Initially, producers were selling at $4, and now they're selling at $6. So the price line will increase, and the consumer surplus shrinks, but producer surplus will increase because the producer surplus is the area between the new price line, the red line, and the supply curve. So what's the new producer surplus? It's this area here, and some of that consumer surplus will be transferred to the producers, and additionally, producers will gain this surplus. Let's put that here. Producer surplus increases. What happens to total surplus? Total surplus will increase. Initially, we did not have this area as part of the total surplus, but now, because of international trade, we're adding this area to our total surplus. We call this gains from trade. After international trade, domestic consumers will buy less in the domestic markets. Let's say it's 300 units instead of 500 units. But producers at $6 world price, they will want to produce more. They will increase their production to, let's say, 700 units. And the difference between the two will be the surplus in this market. That surplus will be exported to other countries. As you can tell, international trade makes some groups winners and some others losers. In this example, consumer surplus shrinks and therefore consumers lose because they're buying at a higher price, but producer surplus increases and producers will gain, producers will win. And although some people will win, some people will lose, in general, in the overall economy, efficiency will increase and total surplus will increase.